here today to tell you about our view of the CIS banks. Actually, I have quite a wide presentation covering almost whole of CIS, but what I would suggest that I cover Russia as a dominant market in CIS, and then it's up to you to pick up another one or two countries depending on the time. So, because I don't know whether you are interested in Azerbaijan or Uzbekistan or Kazakhstan or Ukraine, so it's up to you to choose. Okay, so moving to CIS, nice picture. We cover in Moscow the following countries, 6 of them. We consider that our rating coverage is quite representative. At least in each country we cover institutions of 50% market share in aggregate. So I think we are empowered to make a countrywide summary. Russia. This year we did a very interesting exercise, as well as last year. We made a CFO survey, so we asked CFOs of 110 Russian banks to answer our questions and share their expectations about how the country will develop this year and how they see the banking business will develop this year. I'll present their answers and share whether we agree or disagree with their view. Probably you will then share your view, whether you see something different which was not covered by our survey. The banks consider that the main challenging factors against lending growth this year will be macro and banking regulations, which already covered the pressure on capital, scrutinize requirement for capital for consumer lenders, uncertainty what capital thresholds will be introduced under a new framework, what will be the requirements for core capital and total capital. And of course, competition is high, especially for quality borrowers in some segments. And we see that, yes, it is true, we see slowdown in lending. Last year, the overall loan portfolio grew by 25%, and the majority of it was driven by retail loan. This year, we project that the growth will be at around 15%, while consumer loans, retail loan will drive this growth to a certain extent. 30% of growth in the retail book we expect to be recorded. And in corporate, we estimate it being close to 10%. So the bank's growth anticipations actually close to our anticipations. You see that the banks are quite cautious about corporate lending strategy, and only 20% of only 10% of banks say that they will grow very fast and demonstrate over 20% growth. As I mentioned, it is close to our expectations. What are the industries the banks are really willing to on-lend? And surprise, surprise, trade is the bank's key target for this year. 1/3 of the banks are willing to have exposure to retail trading this year, and manufacturing and retailers. We do share the bank's willingness to on-lend to these companies, of course, depending on leverage status of these industries, because we do know that in all of those industries there are winners and losers. Some companies are still over-leveraged through the crisis. Overheated retail growth, we're really concerned about this, but the banks are willing to grow in this segment quite rapidly, and yeah, we do anticipate the 30% growth to be here. And the banks are willing to grow in consumer loans, credit cards, and SME. The same picture we see last year. Not much changed, and we think that strict CBR requirements to the capital of the banks who are highly exposed to high-yielding projects will somewhat cool off risk appetite of weaker institutions who already faced capital pressure So nothing dramatic here because of regulatory supervision. Where the rates will go? The banks think that their lending rates will grow as well as funding rates. However, we consider that Central Bank of Russia is likely to cut benchmark rates to support economy. And yesterday, Mr. Ignatiev, current head of CBR, actually pointed that they would like to introduce some monetary measures to boost economic growth this year, and out of other measures, interest rate was mentioned. So we consider that the pressure on margin will remain here, but it will be mainly attributable not to growth of rate, but mainly due to competition. And actually, statistics supports our view. You see that in last year, lending rates were on more or less stable mode, as well as funding mode. Funding rates increased in autumn, but now in Q1 we see some softening of funding cost. Return on assets is still a question in Russia because of squeeze of margins and high call for provisions. Because booming retail, we expect this to put provision needs on the bank list of agenda, and this is likely to put pressure on capital. However, the banks actually expect that the asset quality will remain the same as 2012. And we do not agree with this over-optimistic view. Again, as I mentioned, macro conditions are not favorable for both corporate and retail sector. We consider that there is some evidence of over-leveraging of households in Russia, and we see that this credit boom that was in 2011-2012 will give some uplift to the bank's NPLs ratio. This, of course, will influence capital, but the banks expect that it will be the same as in 2012. However, a self-explanatory chart showed that under local GAAP, regulatory capital is on declining mode, and core capital or total capital is close to 13% level. And I'll cover that, and actually this leads us to expectations that it will go down further. Actually, the banks are they're expecting that the capital will be flat. They're not expecting to call for capital to anyone. They're actually willing to maintain retained earnings in their balance sheet, and maybe only 20 of them are willing to go to their shareholder for new capital. Probably those who are wanting to accelerate their lending above the market average. Sources are evident, but given the pressure on retained earnings, we consider that this also will be a challenging task for the banks. Well, actually, here's about Russia, our view, and this in summary. We have a negative outlook on Russian banking sector because of the challenging macro, because of the expected pressure on capital, high core and pressure on margins. We see some evidence of overheated asset classes, and actually capital and lending growth will be something which drives our negative outlook. Actually, we recently published a banking system outlook for Ukraine. Since 2009, we maintain negative outlook for that sector. And we see that GDP and volatility of operating environment as a key negative rating driver for this country. Well, again, the depositors' confidence and funding is fragile here in the country. This drives our negative outlook as well. Profitability is also suppressed. On the positive side, that we still see evidence of support from foreign shareholders, and through the crisis, due to deleveraging mode, the banks accumulated comfortable capital and liquidity buffers, and we see some improvements in loan-to-deposit ratio. We run a number of stress tests for Ukrainian banks, and you can see the brief description of what is on top of our mind for central scenario. In Ukraine, we anticipate up to 10% local currency depreciation and 10% loan book growth. This will lead to contraction of capital adequacy ratio to still comfortable around 14% level. We are more or less okay with that. And under adverse scenario, which has low probability to happen, the situation will deteriorate more. But again, this is not our central expectations. And the next slide actually represents the fragile of liquidity. You know that hryvnia depreciation expectation drives depositor confidence here, and drives high interbank rates. Here, a clear illustration that in October last year, close to parliament election, the pressure on hryvnia was as high that National Bank of Ukraine did not have sufficient liquidity to support it through interventions. And liquidity absorption measures actually lead to very high funding costs. And we consider that this situation will repeat because there is a political will to support hryvnia or not. The liquidity to support it is not sufficient. So here's the story about Ukraine.